Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 873A, and today's date is January 21st, 2016, and the title of the episode is Time to Worry, Financial Talking Heads Not Forecasting a Global Collapse. Now, before I get started, I just want to make an announcement. The video with Gregory Mannarino has been uploaded to the X22 Report Spotlight channel on YouTube, so you can go right over to YouTube, type in X22 Report Spotlight, and it should bring you right over to the video. If you are on the X22Report.com site, you can scroll down a little bit, look over to your right-hand side, you'll see the video there. Or if you're on the news site, which is newssentinel.com, you can go right to that site, scroll down a little bit, and it'll be on the right-hand side. Let's get right into the economic collapse financial news. Now, we're seeing this market fluctuate, and we're seeing the market go down quite a bit. We see the high-frequency traders, the plunge protection team, pushing the market up. They really don't get that 200, 300, 400 increase. Usually it ends up between 20, 50, 100, maybe 150 in the positive range. And they're doing whatever they possibly can to get those people out of the market. And they're pushing it up to allow them to sell off right now because they know what is coming. They know this market's going to continually decline. If we look across Asia, we saw the market was down quite a bit. Of course, in Europe, we had a rumor that the ECB was going to ease a little bit more, and that drove the markets up. And we're seeing that the people in the Eurozone, the consumer confidence, they're not buying all of this. They realize that this global economy is not doing what the central bank and what their governments say it is doing, which is getting better, improving, and everything's going to be fine. We see the consumer confidence fell by 0.6 points to negative 6.3 in January from December. This is well below their expectations, which they thought was going to be around negative 5.7, which is not an increase. It's not any better, but they thought it was going to be around that area. And we see right now that the people are looking at the situation and they're realizing that it seems that this economy is a lot worse than they're saying. And that's exactly what's happening right now. Out in Canada, we understand there's major problems. And one of the biggest problems out in Canada is that Canada's oil patch, there's going to be more job losses in that area. And we see that Canada right now is the most leveraged country in the G7. According to a new report from the Parliamentary Budget Office, the PBO, the household debt to income ratio is now a whopping 171%. What does this mean? That means for every $100 in disposable income, households had debt obligations of $171. I mean, this is the highest level in a quarter century. Now, if there was an external shock to the economy, like the economy turning down, the Canadian people would have a very, very tough time. It would be a complete disaster, and this would have a ripple effect throughout the economy in Canada. And we really see this throughout other countries, but for some reason, in Canada, it's a lot worse. And we are starting to see the economies of every single one of these private Western Central Bank countries really start to fall apart and deteriorate. And as time goes on, it's getting worse. It's not getting better. I mean, it doesn't matter if the stock market goes up and they bring it up 50 points, 100 points. It's not going to change what's happening in the economy. I mean, you can create this illusion and keep it going for just so long. But the foundation, what's happening underneath the covers, it doesn't go away. It actually gets worse, and it grows, and it festers. And before you know it, they lose control over it, and that's what's happening right now. Here in the U.S., we saw initial jobless claims continually fall. And we've been seeing it in a downward trend. Well, things have changed dramatically. We see that the trend now is up. and initial jobless claims has gone up to about 293,000, and we're starting to see since around October the trend switched to a upward motion right now. And we're starting to see a lot of layoffs, and guess what? There's no jobs for the people. And it's getting tougher and tougher for people to find jobs, because as more and more people are laid off, that means there's less job openings. I know the corporate media is out there telling everyone there's a record number of job openings, but they kind of skew this a little bit. I remember when I was working in a corporation in Manhattan, which is in New York, we had open positions, but from above, they told us not to fill it. We went through the motions of interviewing people, but guess what? They weren't allowing us to hire anyone, and we had many, many positions open, and a lot of companies use this. They say, look, we have all these openings, but the word came down from above saying do not fill these positions, and I think this is what's happening in the companies, because we're seeing a ton of layoffs. Southwestern Energy Company, 1,100 people. Pearson's, 4,000 people. Barclays, saying they're going to remove 1,000 investment bank jobs worldwide. Devon Energy Corp, layoffs are coming. We're seeing an update from the United States Steel Corp, 679 temp layoffs. Yahoo, they are predicting they're going to be having layoffs between 20 and 25%. The layoffs are continuing. Macy's is reporting there's going to be more store closures. We can see that this economy is rapidly falling apart. The Philly Fed is out there, and it improved a little bit to a dismal negative 10.2 to a terrible negative 3.5, but it's still awful. And this is the 5th consecutive month of contraction. The more troubling news is that the total collapse in hope. And it looks like we are down to the November 2012 lows for hope in the Philly Fed. And we realize that manufacturing is continually declining, is not improving whatsoever. The Baltic Dry Index has dropped again 3 points to 355. And as we move forward into this year, we're noticing that things are getting worse and worse as time goes on. They are not getting better at all. We see out in Italy, they have major troubles there. The Italian financial meltdown has just arrived in Italy. The Monte dei Paschi, the bank there, is basically imploding on itself. A staggering 1/3 of their loans are non-performing, and the stock price has fallen a staggering 57% since 2016 began. They're going to need a bailout or a bail-in. But the question is, if they go for a bailout, where's the money going to come from? If they go with a bail-in, guess what? The money comes from depositors, shareholders. Most likely, they're going inside the bank. And we see that many of the major European indexes, they have entered a bear market territory, which tells us a lot of the banking systems in these countries, they're going to have a very tough time. United Kingdom is down 20%. Netherlands, they're down 22%. France down 22%. Germany down 24%. Turkey down 24%. Italy down 25%. Greece down 44%. Spain down 30%. It doesn't look good. They just can't flip a switch and have everything be okay. They've already done that back in 2008. They created free money. They splashed it all over into the banks, into the stock market, into housing, into everything they possibly can and everything that they can control to build the economy up. Now it's falling apart. And we see right now that the U.S., it is at the center of the global economic meltdown. Everyone believes it's China. But again, if we look at the U.S. is a consumer-based economy. It's not a manufacturing economy. It's a consumer-based. And if the demand drops, what happens? Manufacturing drops off. So the U.S. right now and Europe they are the center right now of what is happening. And right now we can see that if there is some type of event, if this entire system collapses, which it's going to, back in the 1930s, people had the ability to farm. Nearly 50% of the American population was rural. Farmers made up about, 21% of the labor force. Today, only 20% of the population is rural. Less than 2% work in farming and agriculture. That's a huge shift. And this is going to be a gigantic problem because most of us who are out there working, the majority of the people, are sitting in a cube in an office. And when this economy comes down, what's going to happen with food production, with self-reliance? And the population is not going to be able to get through this easily. And since the U.S. is the number one consumer market with a 29% overall share and a 21% share in energy usage, guess what? We are the center of this major problem. And we have to look at what caused this problem. And if we look closely enough, it's the central banking system. And we're seeing everything right now starting to fall apart, move towards a collapse, because we see trucking is in a steep decline. We see rail deliveries are in a steep decline. We see petroleum going lower and lower, which means more and more jobs are going to be lost in the shale energy sector. We see that banks right now have a huge exposure on speculation with oil drillings. A lot of these companies cannot pay their loans right now. They are hurting. They're letting their people go. And we see that JP Morgan, Bank of America, Wells Fargo, Citigroup, Morgan Stanley, they have energy exposure. And this is going to be most likely the next subprime crisis. Because when these companies fold and they default on these loans, it's going to be a complete disaster. And it's going to have a ripple effect throughout the private Western Central Bank countries. And as time goes on, it will get worse and worse. We are seeing that France, the French Prime Minister, is warning that the EU may collapse in the coming months. Prime Minister Manuel Valls has warned that the European Union faces several dangers that could lead to the bloc's fracturing in the coming months. One of the problems is the refugee crisis. We see the debt crisis is another problem. And we see the economy of these countries is another problem. And it's going to escalate and get worse as time goes on. Now, we see the IMF and China, they are readying digital currencies. And the IMF is out there saying this is going to be extremely beneficial. Well, beneficial to who? Not to the everyday person. It's going to be beneficial to the central banking system. And like I said, we see things moving from the west to the east. Now, I'm not saying this is a positive thing. I'm saying everything is moving in that direction. Do I still think it's controlled by the central banking system? In some respect, yes. I think they are making this move. They just don't want to do it out in the open, and they just don't want to do it without having some type of war to say this is why we need to start the system over in this area. But you can see they are prepping China for this. And we're looking at the situation right now where they're saying, okay, we need to go cashless. We need to have an electronic currency. And the PBOC is targeting an early rollout of a digital currency to boost control of money. And the IMF is behind this. What does this actually mean? Why is there a war on cash? Well, the answer appears to be that the banks and government authorities are anticipating bail-ins, steeply negative interest rates, and hefty fees on cash, and they want to close any opening regular depositors might have to escape these forms of officially sanctioned theft. The escape mechanism from bail-ins and fees on cash deposit is physical cash. And they're worried that people are going to remove their cash from the banking system. They've already seen this in Greece. People went to the banks slowly. They removed the cash, they placed it under their mattress, and they kept it there for safekeeping. Cyprus, they didn't do this, but Greece realized what was happening and they decided to do this. They are worried on a global scale throughout Europe, the United States, Canada, Australia, UK, that people are going to slowly take out their cash and keep it in their homes in some area. And it won't be in the banking system, and they won't be able to take that money that's in the banking system to bail themselves out. To stop this, they need to get rid of cash. And it looks like this agenda is now accelerated. Why is it accelerated? Because they realize the economy is falling apart. They realize they don't have much time. And they're looking to roll this out this year. They're pushing it to be out there this year. So what I would do, which I do right now, and this is my opinion, is I would remove what you can from the bank, only keep in there what you need to pay for your bills. If you can take some of it and put it into gold and silver, which is a very smart thing to do. If you can't afford gold, silver, you can most likely definitely do at this point. Or just keep the cash in your house right now. And of course, put it someplace safe so no one knows about it. But we can see right now they're very worried about this. And we know that Europe, as of January 1st of 2016, the bail-in documents have been turned on. They're ready to be used. We know the United States, the UK, we already have the bail-in documents. They're just waiting for the right time to use them. We see Ben Bernanke and JP Morgan Chase. They've come out and said they're not forecasting any type of global recession. Ben Bernanke saying China is contained. All of this is contained. Well, didn't he say this before? Didn't they tell us back in 2008? Actually, it started in the beginning of 2008 where they told us subprime is contained, real estate prices will not go down, everything's fine with Bear Stearns, we're not forecasting any type of recession anytime soon. The same thing is happening right now. Here we are at the beginning of 2016. They're already telling us they're not forecasting a global collapse or a global recession. Everything is contained. Everything is fine. This is a time to start worrying, because when they say these type of things, that means there is a collapse headed our way. And this time they're saying it's global. Last time they didn't say that. This time it's going to be much, much worse. This time everyone really needs to get prepared, because what happened in 2008 is going to be like nothing compared to what's going to happen in 2016 or 2017, whenever it does happen. But we know at this point that when this comes down, the economies right now are completely interconnected. The derivative, the bond market, the stock market, the housing market, the treasury bond market, the student loan market, all of this has been built up into one gigantic bubble. And we can see at this point, it's going to pop. We see it's going to come down hard. And it's not going to be pretty. And if you haven't made preps, I would start now. Do not delay. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.